As a former UBS material risk taker, I'm pretty long UBS, so naturally I've been following the saga of its capital requirements closely. But it was interesting this week watching the share price behavior in relation to the recent capital requirement announcement. When Switzerland announced draft reforms that would make UBS one of the most heavily capitalized banks in the world, few expected its stock to rally. And yet, on the very day those reforms were made public, UBS shares surged 5% at one point. On the surface, the news looked grim. A $26 billion equity capital increase, stricter treatment of deferred tax assets, reduced reliance on hybrid bonds, and tighter rules for offshore subsidiaries. UBS itself called the measures extreme and neither proportionate nor internationally aligned. So why did the market respond so positively? The answer lies at the intersection of market expectations, signaling theory, reputational capital, and the subtle mechanics of relief rallies. First and foremost, investors had already been bracing for a capital hike. UBS shares had struggled in the months leading up to the announcement, as the market anticipated regulatory fallout from the Credit Suisse collapse. With the government previously flagging a capital uplift in the $15-25 billion range, Friday's $26 billion figure landed just beyond the top end of this range. This is classic relief rally territory. Markets don't just respond to news, they respond to the gap between expectations and reality. UBS stock had already priced in the possibility of draconian measures, and the actual announcement, while tough, was structured and will be phased in over time. It provided clarity. In markets, clarity is often worth more than the specifics of the headline. Markets also recognized what the new rules imply. UBS is systemically important, and the Swiss government is committed to ensuring its resilience. A headline capital ratio between 15% and 17% places UBS at the very top of the global banking safety league, and that matters. In an era when depositors, counterparties, and clients are hypersensitive to counterparty risk, especially post-SVB and Credit Suisse, higher equity capital sends a powerful signal. UBS is not just too big to fail, it's structurally fortified not to falter. High capital ratios do depress returns on equity, but they also dramatically lower the perceived risk of the institution. That can be a net positive for the share price, particularly in uncertain macro environments. There's another layer of logic here, the inverse relationship between capital strength and funding cost. UBS will, over time, be able to attract deposits at more competitive rates and issue debt more cheaply because the additional equity serves as a cushion for creditors. Moreover, the reforms propose a move away from hybrid bonds, which convert to equity in a crisis, and toward pure equity capital. While this might look punitive, it improves the quality of capital on the balance sheet. Hybrid instruments can give a false sense of security. As Credit Suisse learned, they can be wiped out overnight, and their reliability in a crisis is often illusory. Markets have grown wary of Tier 1 hybrids, especially after the AT1 wipeouts in 2023. UBS, by contrast, would have a cleaner capital stack and a lower probability of distress. Over time, this could tighten its credit spreads, reduce volatility in its funding base, and lower its beta, all positives for its valuation. UBS has argued that the tougher Swiss rules place it at a disadvantage relative to US peers like JP Morgan or Morgan Stanley. And on a narrow profitability basis, they're right. More capital means lower leverage and hence lower return on equity. But the market may be reading this differently. Switzerland's conservatism, long viewed as a hallmark of banking stability, is being restored. After the embarrassment of Credit Suisse's implosion, these reforms reclaim moral high ground. UBS becomes not a victim of stricter rules, but the beneficiary of a regime that now credibly enforces stability. In a world awash with regulatory arbitrage, UBS could evolve into a fortress of transparency and strength. That can be a competitive moat, particularly in wealth management and private banking, where trust is paramount. The other lens to view the stock price reaction through is reputational. Switzerland has spent over a century cultivating its image as a safe home for capital. The Credit Suisse crisis shook that image. UBS is now the sole global standard bearer for Swiss banking, and these reforms aim to make it unshakable. Wealthy clients, particularly from politically unstable regions, are not looking for the highest yield. They want the lowest risk. For them, a bank backed by conservative capital rules and an aggressive regulatory regime is not a burden, it's a magnet. With these changes, UBS aligns itself more closely with the Swiss national identity, disciplined, prudent, and resilient. Its advertising slogan, "A bank like Switzerland," suddenly rings more true. Perhaps the most overlooked part of the announcement is the timeline. These rules will take 2-3 years to finalize and a further 6-8 years to fully implement. That means UBS faces no immediate capital shortfall, no forced equity raise, and no dilution in the short term. Investors can see the roadmap and know the destination, but the journey is long and winding. That gives UBS flexibility. It can optimize its capital stack, divest or restructure parts of its business, and plan for compliance without disrupting near-term profitability. In markets, uncertainty kills valuation, but structured time-bound challenges can often enhance it if investors believe the firm will manage the transition. To be fair, there are valid concerns. Holding more equity capital usually dilutes returns. UBS may lag its US peers in return on equity metrics, and analysts have warned that these rules make its shares less appealing in terms of raw capital efficiency. UBS itself protested strongly. Its leadership argued that the real culprit in Credit Suisse's demise was bad governance, not capital structure. They even offered to cap the size of their investment bank in lieu of tighter capital rules. But the market seems to disagree. The bear case had already been priced in. The perceived worst case, immediate capital raises, reputational decline, or regulatory chaos, did not materialize. And even in the face of stricter rules, UBS kept its global ambitions intact. That's bullish. Finally, investors are always thinking a few moves ahead. Some analysts in Switzerland have speculated that UBS could restructure, spinning off its US or Swiss divisions, or in an extreme case, relocate its headquarters to escape domestic overreach. UBS has denied any such plans. But just having that optionality, even if unused, provides a form of implicit downside protection. It gives investors confidence that management is not cornered and that multiple paths to value preservation or enhancement remain on the table. What looked like punishment on paper turned out to be a premium in practice. UBS's stock rose because the reforms, while severe, confirmed the bank's strategic importance, its regulatory clarity, and its safety. The long transition timeline gives it room to adapt, and the reputational benefits for both UBS and Switzerland far outweigh the marginal hit to return on equity. In today's uncertain world, safety is a sellable asset, and UBS just became one of the safest banks in the world. Investors noticed.